This is Richard Flax at MoneyFarm with our regular monthly update. April was a really interesting month for financial markets. And once again, it was US trade policy that was the real driver. On April 2nd, President Trump announced a broad range of tariffs on trading partners around the world. The basic shape was a 10% flat tariff combined with a range of reciprocal tariffs on trading partners. From what we can tell, the reciprocal tariffs were calibrated based on the size of the trade deficit between the US and the partner. In some cases, the announcement prompted retaliation, most notably from China. It's fair to say that the tariff regime was higher than investors had expected, raising concerns that we'll see a significant slowdown in economic growth, both in the US and around the world. In terms of market reaction, we saw equities sell off quite sharply in the few days after the announcement, but the moves in bonds were more interesting. On the fixed income side, initially we saw US government bond yields fall, presumably as investors looked for assets that were perceived as safe. But we actually then saw Treasury yields begin to rise, raising concerns about the creditworthiness of US government debt, generally regarded as among the safest financial assets in the world. A week after the initial announcement, we saw signs of de-escalation. The president announced a 90-day pause from the US on countries that hadn't retaliated. At the same time, the US and China continued to raise tariffs on each other's products. But even here, we began to see exemptions for certain products on both sides. Equity markets in particular have taken some comfort. At the start of May, the US equity market returned to the level it reached prior to April 2nd. Looking at key data points for the month, we focused on the figure of 145%, the headline tariff rate the US imposed on Chinese goods. It's a dramatic figure for one of the largest exporters to the US. Even if we start to see exemptions for certain categories, and even a de-escalation, we'd still expect to see gaps on the shelves of US retailers in the coming months, as businesses try to digest the tariffs. We think there are a few ways to think about this. First, the US administration believes that the US has been treated unfairly by its trading partners and should equalize that relationship. It thinks tariffs are an effective way of achieving that. Second, the administration sees tariffs as a way to raise revenues to help improve the government finances and help finance a cut in tax rates. Finally, the administration sees its tariffs as a negotiation with its partners. Viewing tariffs as part of a negotiation makes life harder for investors and businesses. The goalposts move constantly as new announcements supersede previous policies. Knee-jerk reactions to the latest news can cost investors even hours later. As for how it'll end up, it's tough to know, of course. We think we'll continue to see a de-escalation from the tariffs announced on April 2nd. There are a lot of negotiations underway, and they take time, but we think all sides will be keen to show at least some progress towards lower tariffs. But it won't necessarily be a quick process, and we don't expect tariffs to return to their pre-April 2nd levels. So we'd expect to see an impact on growth and inflation over the coming quarters, but far less than might have been feared in the days after April 2nd. What does it mean for portfolio positioning? In general, we'd argue for a conservative stance at this point, as higher tariffs slow down economic growth. But as we saw in April, markets can reverse course really quickly, and that should make us wary of trying to predict short-term moves. Thank you for watching and look forward to speaking to you again soon.